watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, David Shapiro from Sasfin Securities, Gary Booysen from Rand Swiss. Be sure to send your questions via email, stockwatch@bdtv.co.za, SMS on 41392, or on X at Business Day TV using hashtag Stockwatch. Gents, appreciate the time. David, new inflation basket, frozen chips and condensed milk is out. Rosé wine and vape products are in. I mean, be that as it may, 3.2% for January. Same old, same old.
Yeah. Well, I'm out the basket because I don't vape and nor do I drink rosé. So that's me gone. But, it's a commendable number. And I think now we just wait to see what the next move on interest rate is.
Yeah. And
there doesn't seem to be any kind of loosening of the governor's policy. He's still worried about Mr. Trump. I can understand that. I give all my sympathy to to Lesetja, but somewhere along the line, you've got to look at the economy. And just briefly on that, Simon, the results coming out are not that great. This is an economy that's really battling. Take out the process and Naspers and all those businesses that don't operate in South Africa. So I'm just hoping that this does influence another rate cut.
Yeah, another cut would be great. Gary, let's go to some of those results. Bidcorp, I mean, they're not very local these days. Of course, they've got local operations. I got to say, management there just continued to impress, is my sense. And the results are 10% up in HEPS. We could argue that might be a bit light, but I thought not bad. You're taking Bidcorp.
Yeah, it's about pretty good. So, I mean, Bidcorp obviously spinning out of the Bidvest stable. It's an incredibly well-run business. It's got such a good management team in place, and historically they've kind of been sitting back a little bit, so not really doing a lot of acquisitions, and that's changed in this period. So we've seen eight new acquisitions. Revenue, kind of mid to high single digits, so nothing like really exciting, but you do get the sense that as a food services business, as the consumer maybe gets a little bit stronger with interest rate cuts, they should do fairly well. And they're saying it's not just the acquisitive growth that they've managed to achieve, it's also the kind of 5% real after inflation adjusted organic growth. So yes, a solid set of numbers, but you do pay a premium for Bidcorp, of course, but solid stock, maybe a little bit expensive, but for South African investors, a fantastic rand hedge.
Yeah, absolutely. David, you're taking the Bidcorp. I mean, they sell little tubs of butter, and yet they make billions.
They deliver it to the canteen, yes. But, in a big truck with other stuff as well. But, credit to management. They've never diverted from their aims and their strategy, and they just keep delivering. Yes, it's not outstanding. It's not going to knock the lights out. But, if you look at the share price, I think it just mimics what the company's doing, just creeping up all the time. So very solid, good performer. And in a market, I'm talking our market, where there's not much choice, you're not going to go wrong with this one.
Yeah, I hear you on that. We also had numbers out from AECI. Bang Bang is what they used to be. Market really liked it. Stock up 7%. David, I mean, I thought not bad.
To be honest, I wasn't here this morning, so I haven't really gone through them in great detail. I just saw a lot of minor signs and problems around them. It is a business I've always liked because they're basic, agriculture, chemicals, mining. I'm not quite sure what was behind the negative numbers, but I'm pleased that there was something there that lifted the market, that the market liked in it, because I was a bit disappointed just looking at it superficially. But hopefully it is pointing to a turnaround in those three areas.
Gary, I mean, it's looking at the chart, it's back where it was just pre-pandemic. I mean, it hasn't done us a heck of a lot. I suppose in some senses that is sort of a story of our mining, chemical, agricultural space. AECI, is it one you keep a close eye on?
Yeah, it's not one we keep a close eye on, but looking at that chart, as you say, for me, that looks like an amazing trade. If you can get in kind of low 90s, get out at around 110, it's a beautiful range for you to trade on that one. As David said, I mean, it has been the business has struggled a little bit. Remember, this is a business with an incredibly long history. So I think last year they were celebrating 100 years since incorporation. I think they were listed on the JSE in 1966, but kind of a new business model, trying to streamline and get things right at the business. In terms terms of they released a trading statement before these results as well, and they are making a basic loss per share, but if you kind of exclude all the discontinued items, they're saying that they are making like a diluted continuing operations profit. But it's a business that I think is struggling to achieve profitability, and I think one of the big focuses of management at the moment is I think they want to double profitability by the end of 2026. So they really are focusing on just like trying to get the business a lot more streamlined. They sold obviously much asphalt, so they got about 1.1 billion for that as well, which is now being excluded. But yeah, compared to the trading statement, that basic loss per share was right in the middle of the range. So yeah, market obviously liking it, looking at maybe the renewed strategy and saying, hey, wait a minute, or maybe it's just technical traders looking at that chart going, hey, we can trade that range right the way back up.
I take your point. It is a great trading range and a nice and easy, 90 to 110, and we hit the 90, so now it's running again. Gary, let's stay with you. Question coming through around Aspen. I mean, once an absolute darling of the JSE, perhaps less so these days. Would Aspen be a stock that you would add to your portfolio?
No, Aspen's a difficult one. So looking at Aspen, it's kind of the stock price has been in the doldrums for a long time now. But I mean, you kind of like the story behind Aspen, and I don't think it's particularly expensive. I mean, you've got a management team that is buying its own shares. You got a significant stake in the business, so you kind of understand that the shareholder interests and management interests should be aligned. I mean, it's a wonderful South African story about Stephen Saad and them started a little business in Durban and became a multinational company. So you also kind of look at it from a and it's always not clear for Aspen, is that a rand hedge or not, because the share price is not perfectly correlated to the currency. If anything, it's almost ignored. But they have these huge manufacturing facilities in South Africa, very, very sophisticated manufacturing facilities, and then can export their generic drugs all over the world. So it should be a very, very good company. Obviously, a lot of people are very concerned about the debt that they took on and their very acquisitive strategy as they grew. But you get the sense that the business is consolidating, and maybe a few shareholders have had their fingers burnt and are a little bit more circumspect around what I think is a very, very good company. And maybe it just takes a little bit of share price appreciation to actually see some of that excitement come into the stock again.
I mean, David, this used to be a go-go stock. Looking at a 10-year chart, I mean, 10 years ago it was over $400. Your take on Aspen? And to be clear, Mrs. Saad sometimes watches the show, so be polite.
I know, and she's going to go at you. She doesn't know who I am. But overall, it is a good business. And Gary made a very important point. They've got capacity to produce so much more in their operations. And I think every time they come with results, I think, which are due next week, somehow they disappoint us. But, at a time where Africa is open for them to produce, especially now you've got the GLP-1 blockers coming and all those drugs, they can actually manufacture those and serve Africa and serve. But we're all waiting for it. It doesn't look particularly pricey at the moment, and hopefully if those results give us some kind of clue what lies ahead, it might be a buying opportunity. But I think so far it's disappointed over many years.
Well, you talk about results and buying opportunities. Questions coming through. Sibanye-Stillwater, results out last week. Today they announced that they're pulling out of one of their JVs. Sibanye-Stillwater, which even the gold, I mean, they don't do much gold, and their all-in sustained cost is like, what, 2,200. David, is Sibanye-Stillwater on your list?
Sadly, no. And when I love Neil Froneman, he was always good value for his opinions and so on, always forthright. And when he started the business, which was buying defunct gold mines and taking whatever he could out of them, I quite like the idea. But over the time, of course, it's changed, it's transformed. So I looked back when he announced his retirement. I said, okay, let's see the legacies left. And I looked sideways, and I looked right, and I left and right, and the price was the same as when he came in. So I don't know what legacy we've got out of Neil. I'm sure he's made plenty of money along the way, but it's been a very, very volatile ride. And even now, we're not quite sure what the next move is. Not seeing any help from the platinum or palladium price other than gold, which is not really big in their lives anymore. So are not that big anymore.
Not that big anymore. Gary, I mean, I don't know. Sibanye-Stillwater to me is a trading stock. This is not a bottom drawer. Would you be looking to build a position now, or is it rather a case of we've got to wait for those PGMs to start moving?
Yeah, well, I think that's it. If you look at the most recent results, it really was the gold that was doing the heavy lifting. So even at that higher ASIC and gold, it kind of did diversify the portfolio and almost save it at an EBITDA level. As you say, I think at the moment, Neil is stepping down. You've got Richard Stewart coming in. He's had a long history with the group. He's been one of the people that have been involved in taking it from the spin out that it was, a couple of, very deep, very difficult to mine gold miners and turning it into a multinational PGM producer. So, I think the legacy is, for shareholders, maybe not always that great. I mean, like David says, it's been a very wild ride. You've been rich, you've been poor, but I suppose that's what you get when you buy into mining stocks. I mean, they're not for the faint-hearted, and you're always going to have higher volatility on them. But, overall, I still think that the way that they speak about returning capital to shareholders as well, protecting shareholders. Yes, it's going to be volatile, but it's also volatile because of the commodity basket that they're exposed to. They're doing what they can to diversify from that, looking at lithium, cobalt, nickel, all the battery metals. They see the issue that's in the PGM market at the moment, which is dominated by the demand for autocatalytic converters, which is fine in hybrid vehicles, but not great if you go with full battery-powered electric vehicles. So, I think it's still always going to be it's a buy for me, but it's always going to be speculative. Just remember, there's always that spec in front of it because it's going to be difficult. And at the moment, obviously with the management change as well, I think Richard Stewart is more than capable of running the company, and I think you'll see a lot of continuity from when Neil Froneman was running it. But whenever there's a management change, obviously you've got to be concerned how are things going to be different now. So it does add level of risk as well.
And quick, after we're chatting around on Monday on PGM, someone was saying, what about the green hydrogen economy? I got to say, there was a lot of excitement around that maybe 4 or 5 years ago. My sense is it's kind of disappeared.
Yeah, to an extent. So at the moment, you look at it, whenever you talk about like the adoption of new technology, hydrogen, battery-powered electric vehicles, it never kind of goes in a linear fashion. And I think a lot of analysts kind of go and they draw this like very linear chart as a hockey stick adoption. So, I think there's a lot of promising technology in kind of green hydrogen and that, but the adoption is going to be very uncertain because it kind of tends to hockey stick. When it's adopted, it's almost adopted all at once. And then things change very, very quickly. And that level of uncertainty is always a concern around the PGM stocks.
David, news out this morning, Barlow World, their attempted takeover, they needed 75% for approval. They got in the mid to high 30s. In other words, it failed fundamentally.
Yeah. That was on the cards.
Yeah, a bit messy.
That was on the cards. Once management was involved, and I think that was the deep concern. I'm surprised. I thought they would have pushed it through, but I think the market would have been very angry. The fact that the CEO and was involved in part of the takeover, I think it did raise suspicion. So I'm not. It's a great what's the word? It's a victory for shareholder activism and for corporate governance. I think there was a lot of suspicion, and around the whole deal. So I didn't see the share price. I'm not sure. I see that it is one of the big losers, not too serious, only about 5% down. But I don't know what the next move is now. Where do they go to from here? But sure, the fact that they didn't get approval is a big slap on the wrist for them. I think if slap in the face more than on the wrists.
Gary, is this an opportunity? I mean, the stock's down a little, only 5%. It's like 103 Rand or so. Ahead of the first caution year of last year, it was trading around $60. I mean, is there a sense of opportunity, or is it more a case of that 60 Rand price is perhaps more what we should focus on, and it's going to maybe drift lower?
Yeah, I would be concerned. I'd rather say, be very careful. And it's not just around the deal structure and potentially the 60 Rand price. It's also that Barlow World's operating environment. Remember, as well as kind of being the exclusive dealer of like this big yellow machines in South Africa. I mean, they operate in places like Russia as well. So there's significant risk in the company. I mean, it's not particularly expensive at kind of like 10.5 times earnings. But yeah, I don't know. We're steering clear for now.
Yeah, and there is an investigation. I mean, to their credit, they went and told the US authorities, but there is an investigation coming out of the US as well. Gary, staying with you, question coming through on the emails, or rather the SMSs. Coronation or Sygnia? I mean, in some ways they're different, although I suppose broadly, Sygnia does a lot of life as well. But would you be looking at either Coronation or Sygnia?
Yeah, I lean towards Coronation, although I don't know. I think Sygnia is going to have a cracker set of results coming up pretty soon, because obviously Sygnia has always positioned themselves as this low-risk platform, at least not low-risk, low-cost platform. Trying to bring in as many assets as they can. And this year they've kind of decided to unilaterally hike their fees aggressively. So I think you're probably going to be in for quite a windfall if you're a Sygnia shareholder. But the problem is that going to deter so many of the clients that have kind of adopted the Sygnia platform for their investments just because of the lower platform costs. Coronation, on the other hand, I think Coronation, they've obviously got that court case now sort of behind them. They, not looking at what they were doing in Ireland, I think they're clear to an extent, and with markets running as they are. So I think the idea of buying into one of the largest asset managers in the country, and obviously the profitability that they're going to generate with higher equity markets, and we do have equity markets breaking record highs all over the place. That will feed straight into their bottom line as well. So I think for me it's probably Coronation longer term, but Insignia obviously a lot smaller business than Coronation as well. So kind of going with the bigger option, a little bit more stable as well. Yeah,
and I like your point. We are at all-time highs, or just if it might not feel like it, but it is a true statement. David, Coronation, Sygnia?
Sygnia, it's a $3 billion company that's Coronation probably 4 or 5 times bigger than that. But it's very difficult. Liquidity is very tight there. And that makes it difficult to build up a decent stake. But Simon, you're absolutely right. I think we're going to have some really good numbers coming out of the asset managers, whether it's 91. I know last set wasn't brilliant, but that was a few months ago. I think things are working in the favor of people who've got assets under management. And we saw it in Momentum's results today as well. That whole industry doing well, Discovery doing well. And what else is coming there? But it does look like it's going to be a good year for some of these businesses. So, I don't know which one. Coronation looks cheap.
Yeah, okay. Coronation looks cheap. David, staying with you, NEPI Rockcastle. I remember, these guys could do a book build. They could raise billions of rands before breakfast on a Tuesday morning. Those days may be a little bit behind them. Still all over Eastern Europe. NEPI Rockcastle, your take?
Yeah, I've lost touch with the property stocks. I know they've been creeping up, particularly those that have gone offshore. I haven't got a great feel for what's happening in Romania and some of those eastern countries, So I'm a little out of touch there, and I don't think my opinion is going to hold much sway. It's like you, I remember it. It was very fashionable at time when the property companies were going up. But at the present, present rate, I'm not sure. Listen, Europe's done well. The Euro stocks is up about 14-15% in the first 2 months. Way higher than the rest of the the S&P, and that might be reflecting a turnaround in the European economy. But I'll defer to Gary. He knows a lot more. He's got screens in front of him. He can touch buttons and come out with instantaneous views,
Well, I think we should be doing a site visit to Romania. That would solve maybe part of the problem. Gary, NEPI Rockcastle and the numbers earlier?
Yeah, I did a site visit to Romania and to Poland, and it is amazing the feeling that you get in that economy, in both economies. Okay, Romania not as much as Poland, but there's a lot of construction going on. There's a lot of economic activity, and it really is backed up by the numbers as well. They've got a low unemployment rate. You're talking about 4.5%. Just under 4.5%. It's a young population as well. In GDP terms, they're growing at almost twice. So if you look at Central and Eastern Europe, it's growing at almost twice the Euro area in terms of GDP growth as well. So they are fairly exciting economies. Looking at NEPI Rockcastle specifically, they still buying and building and doing all the things that they do. So they've got 2 new greenfields projects in Romania. Their LTV is still below their kind of 35% covenants. I think it's coming end of 2024 is about 32%. So it looks decent. Their occupancy rates are at record highs. Their occupancy is at like 98.3%. So I mean, it is an incredible business, and anyone that's kind of like, you know, look down on that Eastern European story, I think has had it wrong for the last kind of 10 years. But in terms of the actual share price, it's also expensive. A lot of this news and a lot of the story is priced into it. And I mean, if you look at the share price chart as well, I mean, it's kind of steadily ticking higher. There's a lot of holds out from the sell side. If you convert it back to kind of euros per share, it's trading just above €7 per share. So kind of price targets are, you know, kind of like mid sevens for most of the analysts. So I don't know how much left there is just in terms of pricing to go and buy their securities at the moment. But as a business, from an operational point of view, still doing very well.
Yeah, no, and that's often the case. Good stocks, but maybe not good prices, or maybe too steep a price. AB InBev question coming through from Don saying worth having a look at AB InBev on a 3 to 5 year view. Gary, SAB used to be a flyer in our market, but it's gone a bit flat with AB InBev.
Yeah, AB InBev. So again, it's, I mean, what, they serve 1 in 3 beers internationally. So I mean, it's an absolute juggernaut, and it's difficult to see where it's not a growth stock. It's not going to be a growth stock. And also, the AB InBev management team is not a growth orientated. SAB was the kind of management team that, you know, tried to create organic growth around their products. AB InBev is kind of more of an M&A team. They come in, they buy something, they strip it down, they make it hyper efficient, and it's all about profitability. So yeah, AB InBev, again, I think the competition in the space is also increasing significantly. You know, likes of craft beers, you know, people that have also just apparently the new generation is just the Gen Alphas. They're not going to drink at all. Like, that's what seems to be the view. So I don't know if they have to go into non-alcoholic beverages as their growth strategy. I mean, certainly Monster seems to do fantastically well. But yeah, it really is. I mean, it's a good dividend payer. It's a rand hedge for South Africans that want to kind of buy inside, you know, local trusts or local companies and don't want to have to go and set up an asset swap. You know, if you don't want to use your exchange control allowances to get offshore, it's a nice way of getting multinational exposure. But you know, if you weren't looking at our exchange controls or the way that South Africans are taxed, I think you can probably find better things in the international space.
Yeah, and it is alarming that the new generation aren't drinking on every single level. David, we need to go to stock picks. You're going with Nvidia. The results are due, Wednesday next week?
Today.
Oh, sorry, this week. I mean, this week.
Yeah, after market close, yeah. It's very important because it's going to define the trend on the Magnificent Seven and all those AI stocks that have been under quite a lot of pressure and are coming down to very attractive levels. Even Nvidia itself is, I think, below 30. It's a multiple, you know, which for a company that's grown the size they have, this is attractive. What the results are going to be, you can bet that there are going to be many analysts who see the glass half full, others that see it half empty. It's that kind of stock. But we got to get over this noise. It's still a very important business, and at these kind of levels, and I've no doubt the results will be outstanding, even though they might underwhelm some. You know, that whole area of the market is beginning to look very attractive again.
Yeah.
So I'm going to just use it as a proxy for the Mag 7. Okay. With my Mag 7, I ignore Tesla, hey?
Yeah, it's a Mag 6, eh?
I put Broadcom in, yeah.
Okay, so Nvidia there. Gary, Russell 2000.
Yeah, so I'm not going with the traditional Russell 2000 ETF. I'm actually going with the iShares US Small Cap Factor Equity Factor ETF. So the ticker is SMLF. And all it does is the Russell 2000, essentially 2,000 companies, and it's kind of the small mid-cap sector in the US. And yeah, I think there's a lot of concern, and certainly like we're hearing it a lot from clients around just the concentration that you're finding in something like the S&P 500. You know, the Magnificent Seven has just done so well, and it's become such a large part of that index. But with, I suppose, the deregulation that we're seeing in the US at the moment, you do expect the US economy to do really well. The problem is that maybe some of the pricing of these Magnificent Seven will turn them into I think the guy who actually coined it, I can't remember which bank he's from, is now calling them the Lagnificent Seven, saying that the next 10 years, they're not going to actually deliver the same kinds of results. So if you want to capture kind of the broader US economy, looking at something like the Russell 2000 is your option. But if you look at the small cap multi-factor ETF, it's kind of top ranked, and it generally outperforms because what it does is essentially just looks at a couple of general factor rankings to try and discount the real garbage that sits in those 2,000 stocks. So you come out with about 800-900 stocks inside this ETF, and over the last 7 years, it does kind of it's done 9.6% annually versus the Russell 2000 that's done about 6.8%. This is in US dollar terms, so a significant outperformance of that. And if you look at its volatility as well, also a lot lower. So if you look at kind of the efficient frontier, it gives you a higher performance historically speaking at a lower risk, at a lower standard deviation. So yeah, for me, if you're looking to broaden out of the S&P 500, this is something to look at.
Okay, we'll leave it there for Stockwatch today. Thanks to our guest, David Shapiro from Sasfin Securities, going with Nvidia, Gary Booysen from Rand Swiss, going with a Russell 2000, but the factor-focused one. Do note, Stockwatch will be pre-recorded at 12:30 on Friday. Be sure to send your questions via email, stockwatch@bdtv.co.za. Up next, The Close. Stay watching.